Good morning. What is a capital stack in commercial real estate? Well, in commercial real estate or CRE, understanding the capital stack is essential. It's the foundation that determines who gets paid first, who takes the most risk, and how returns are distributed. Now, whether you're a developer, investor, or lender, knowing how a deal's capital stack is structured gives you a clearer picture of potential risk and reward. So, what is a capital stack? As you might be wondering. Well, the capital stack represents the hierarchy of all capital invested in a commercial real estate project, from debt to equity. And each layer of the stack carries different levels of risk, priority, and return. Generally, the lower layer, the lower the risk, and the lower the potential return as well, unfortunately. The four main layers include first being your senior debt, the foundation of most deals. This is usually provided by banks or institutional lenders and has the first claim on cash flow and collateral. Then you have mezzanine debt as the second layer, a higher risk loan that sits between senior debt and the equity component. Mezz lenders often receive higher interest or warrants. And then you have preferred equity. So investors here get priority over common equity, but it also doesn't have the same security as the debt holders do. And there's common equity is the fourth layer, the riskiest but also the most rewarding position. Common equity investors are paid last, but enjoy the upside of appreciation and profit. So, why the capital stacks matters is our next segment. And understanding the capital stack will help you in these ways. First, you can gauge risk exposure, know where your money sits in the repayment order. It can help you negotiate better terms. Lenders and investors structure deals based on perceived risk. It helps you plan your financing strategy. So you can optimize your leverage by blending different layers effectively. And for mortgage brokers and investors, structuring the right capital stack can make or break a deal. And at Medallion Funds, we help investors, developers, and business owners align their debt and equity structure to maximize returns while minimizing their exposure. So, for this next segment, let's take a look at an example. It's a simple capital stack breakdown. So, let's say we're developing a $10 million retail center. And then we can go out and get financing for the project, say $6 million, 60% equity from a bank at, say, 6%. Then we have a mezzanine debt layer above that, say $1 million from a private lender at 10%. Then we have preferred equity, 1.5 million from an investor group who wants an 8% preferred return. And then we have the common equity, which is the 1.5 million from the developer's own funds. And this layered approach allows the project to be financed efficiently while balancing the risk and reward among the stakeholders. So here's the pro tip. Investors who understand how to blend capital sources from traditional banks to private capital will gain a competitive advantage. They can close deals faster, negotiate better terms, and attract partners who value strong deal structuring. And here's the final thought. The capital stack isn't just financial jargon, although it sounds like it sometimes, but it's the blueprint for every commercial real estate transaction. Knowing where you stand in the stack gives you clarity, control, and confidence in your investment decisions. And at Medallion Funds, we specialize in helping borrowers and investors structure winning capital stacks that align with their goals and risk tolerance. And that is all for the day, folks. Hope you have a good one.